Hi everyone, good evening. So let's just wait for about 5-10 minutes in case somebody wants to join. We will be continuing with the questions that we were having a look at. Last week we had a question bank. So we will be continuing from question number 15. Yeah. So I'll just wait a few minutes in case somebody wants to join. Okay, so I guess we'll start. Even if somebody joins in later on, no problem. Every question is standalone. So, even if they miss a question, no problem. They can always continue from the next. Okay. Right. So this question, this particular question, it is one of those questions that they tend to ask over and over again. Okay. For some reason, I don't know why, but they usually ask this question at least once in a paper. Okay. So it's like a guaranteed MCQ that chances are that you will see that when you're sitting for your exam. So let's read what it says. A company made 17,500 units at a total cost of $16 each. Okay, so they have made 17,500 units and the cost they incurred was $16. 3/4 of the cost were variable and 1/4 was fixed. So what they're trying to say, in this $16, 3/4 of it is variable. So if you take 3/4 of 16, we are talking about 12. Okay, that is variable. And the remaining quarter, which is 4, that is fixed. Okay, so they're just saying that we just wrote it down. There were no opening inventories. By how much will the profit calculated using absorption costing principles differ from the profit if marginal costing principles had been used? Okay. So you must be already familiar with the concept where if you want to cost a product, there are obviously different methods that you can use. Okay, so if you want to cost a product, especially if you are in the manufacturing industry. So, the traditional manufacturing where you will have mass production of one unit. So like maybe you're making so many desks, so many chairs, so many pens. Okay, so that kind of business is what we call traditional manufacturing. So if you are a traditional manufacturer, then more often than not, you will choose one of these two techniques, either absorption costing or marginal costing. Okay, so to cost your product. So for example, if you are making discs, if you want to know the cost of one disc, you will either use absorption costing methods or marginal costing methods. Okay, both of which we have covered in this syllabus. So let me just quickly run through the difference between absorption costing and marginal costing. Okay, right. So if you take a cost card, so cost card is basically a breakdown of the costs incurred to make a product. So let's say we are going to make discs. Okay. We can say the first cost and the most straightforward cost is direct material. So direct material for a disc, it may be something like wood and maybe paint. Okay. So let's say for one disc, the cost of direct material that we're incurring. So let's say we are using 3 kilos of wood. Sorry. We are using 3 kilos of wood and say 0.5 liters of paint. Okay. So the 3 kilos of wood and 0.5 liters of paint together, let's say it costs us $30. That's the cost of direct material. Okay. Then the most second important cost, direct labor. So if you talk about direct labor, that is the amount that you are paying as salary to the people who are making the discs. Okay. So let's say one disc, it takes about 2 hours to complete. And say our rate that we pay per hour is $5 an hour. So 5 into 2, the direct labor cost will be 10. Okay. Then we can have something called a direct expense. There is only one example of a direct expense, and that is if you are paying any royalty. So in the case of a disc, it may not be there. But suppose you are paying somebody, say $1 per disc. Okay, you have to pay it. Let's say it's a special kind of disc that he designed. So you have to, every disc that you sell, you have to pay $1. So let's just say direct expense is $1 per disc. Okay. So direct material, direct labor, direct expenses, there is no difference between absorption costing and marginal costing. It's the same. Now, after this, we see the difference. So what is the difference? It's a very simple difference. If you are doing absorption costing, okay, so if you are going to do absorption costing, then any fixed overheads that you incur, things like rent, electricity, the salary of maybe supervisors. Okay, so any indirect cost, which we call fixed overheads, if we incur that, let's say we incurred overhead costs of 700,000. Okay, total after we added the rent, the security guard salary, the electricity bill, once we added everything, it was $700,000 total. Okay, then we will figure out a way to incorporate this 700,000 into the cost unit. So one way maybe we can do that is divided by the number of discs that we actually produce. So let's say we produce 100,000 discs. Then the fixed overhead that we are going to allocate for one disc will be $7. And then we will add all the costs together, 30 plus 10, 40, 41, 48. So we'll say the cost per disc is $48. This is absorption costing, where we have the fixed overheads. We figure out a way to incorporate the cost of the fixed overhead into the cost unit itself at the beginning itself. Now, this is stage 1. We have incorporated the fixed overhead cost. Okay. Now, what is marginal costing? Until this point, it's the same. Okay. So, until the point where we have incorporated the direct expense, it's the same. But with marginal costing, we don't do this. Okay, we don't take the overhead cost and put that also into the cost of the unit. We keep that separately. We take a total over here itself. So that will be 30 plus 10 plus 1, 40. 30, 40, 41. Okay. So we say that the marginal cost, okay, we say that the marginal cost is 41. And using this cost, we will, calculate our selling prices and so on. And then finally, once we have the sales revenue, once we have the cost of sales, once we get a tentative value for profit, then as a last deduction, we will deduct the total fixed overhead. So the entire 700,000, in the end, we will just deduct it from our sales minus the cost. And then we will arrive at whatever profit that we are going to make from selling these discs. Okay, so the difference between absorption costing and marginal costing, in absorption costing, the overhead cost, we incorporate it into the product in stage 1 itself. At the beginning itself, we have put it into the cost of the product. Whereas marginal costing, we even consider the fixed overhead cost only at the end. Okay, in the last stage where we had calculated everything, the sales revenue, the cost of sales, after everything is calculated, at the end, we'll deduct the fixed overhead cost and arrive at our profit. Okay. So there are two different methods. Okay. So one is not correct, one is not wrong. You can use whichever one you want. Both are correct. Okay. Now the question is, why are we having two methods in the first place? Why can't we just, have one method, make things easier for us? The thing is, depending on the method that you use, the profit that you show in your statements will change a little. Okay, so depending on whether you use absorption costing principles or marginal costing principles, the end profit that you show in your statements, it can change a bit. So if a company wants to, kind of show a different, like for example, if they have too much of a tax liability and they want to actually show a lower profit, then they might choose the method that is giving the lower profit. If they want to show a higher profit, then they might choose a method that will show the higher profit. Okay. But finally, what you have to understand is this. Okay. Now, in this question, what are they trying to say? They are saying, if you have the absorption costing profit, okay. Now, we have the absorption costing profit and the marginal costing profit. I told you both the figures will be different because in one, the method is we are incorporating into the cost itself. In another, we are deducting it later. Okay, so you will see that the absorption costing profit and marginal costing profit will be different, slightly different. Okay, not a big difference. Slight differences will be there. But what you have to understand is, suppose they give me the absorption costing profit, 500,000, for example. Using this 500,000, I can calculate the marginal costing profit. So I don't need any other data. Okay. Just this 500,000, and one more piece of information that I need is the fixed overhead absorption rate. Okay. So I'll come to that in a second. But these two pieces of information, that is enough for me to calculate what the marginal costing profit would have been had we used marginal costing principles. Okay, so using one profit, absorption costing profit, I can get the marginal costing profit. And the other way also it can work. If you have the marginal costing profit, let's say it's 480,000, I should be able to calculate the absorption costing profit as well. Okay, so in this question, they are testing that. Okay, so what are they saying? By how much will the profit calculated using absorption costing principles differ from the profit if marginal costing principles had been used? So they're asking you, what is the difference between absorption costing profit and marginal costing profit? Okay, so let me take you to a particular slide now to show you how to do that calculation. This slide. Okay, it's a very important slide. Take a screenshot or a picture or whatever, because it summarizes how to get absorption costing profit from marginal or vice versa. Okay, so it says here, the difference in profits calculated using absorption and marginal costing is due to the way in which closing inventory is valued. Okay, what I mean by that is, look here. Here, if I used absorption costing, I will value my closing inventory at $48. right? Because this is my cost per unit. I will value it at 48. But if I use marginal costing, then the closing inventory, I won't value at 48. I will value at $41. Okay. So just the valuation of closing inventory, that's the only difference between absorption costing and marginal costing. So if we need to calculate the difference, then we have to work with that, the difference in the inventory. So it says here, with absorption costing, we included fixed overheads. With marginal costing, we didn't include fixed overheads in the cost card. I explained that. So the difference between the absorption and marginal costing profit will be the change in inventory. Okay, the change in inventory multiplied by the fixed overheads per unit. Okay, because like I said, the only thing that changes is the way we value inventory. Okay, so if we have to get the difference between absorption and marginal, then get the change in inventory and multiply it with the fixed overheads per unit, because in one method, in absorption costing, we included this fixed overheads per unit. In marginal, we didn't. So if we want to get the difference, take the change in inventory and multiply it with the fixed overheads per unit. Okay. So let's do that. The change in inventory into fixed overheads per unit in this question. One second. Okay. So if you look at the change in inventory, they are saying we made 17,500 units, and then they're talking about the cost at a total cost of 16. 3 quarters were variable, 1 quarter was fixed, but they're saying we sold 15,000 units. Okay. So the change in inventory would be the production, because they're saying also there is no opening inventory. Okay. So the production is 17,500 minus the sales, which is 15,000. So the difference will only be the change in inventory because we didn't have any opening inventory. So 17,500 minus 15,000, the change is going to be 2,500 units. Okay. Now, if we want to calculate the difference, it is going to be the change in inventory. Okay. Usually when you put that triangle, it means change. Okay. But anyway, I'll write it. Change in inventory multiplied by the fixed overheads per unit. So the change in inventory we know is 2,500. The fixed overheads per unit, they're telling me of this cost of 16, 3 quarters are variable and 1 quarter is fixed. So $4 is the fixed overheads that I have to include. So 2,500 into 4, the difference between absorption costing and marginal costing profit will be 10,000. Okay. Now, let's say, okay, in this question, it's not given, but let's say the absorption costing profit was 50,000. We know that the difference between absorption and marginal will be 10,000. Okay. But now the question is marginal, is it 60,000? Because then also the difference is 10,000, or is it 40,000? Then also the difference is 10,000. One is higher, one is lower. Okay. We know that the difference between absorption and marginal is 10, but we don't know whether absorption is going to give the higher profit or marginal is going to give the higher profit. Okay. So to identify that, just look at this. When production is greater than sales. Okay. So if production is greater than sales, then obviously the inventory will increase because we have produced more and sold less. So the amount of inventory is going to increase. In that situation, absorption costing gives the higher profit. Okay, so if inventory increases, absorption costing only gives the higher profit. And if you look at the second point, it says if production is lower than sales, so we have produced less and sold more, then what has happened? Inventory is reducing. So when inventory decreases, marginal costing gives the higher profit. Finally, when production is equal to sales, there is no change in inventory. So both will give the same profit. So let's see in this situation whether production was greater or less than sales. So they're saying we made or produced 7,500 and we sold only 15,000 units. So that means we have produced more than what we have sold. Okay. So production is greater than sales. If production is greater than sales, then what does that mean? Inventory has, production is greater than sales, so inventory has increased. So if inventory has increased, that means absorption costing gives higher profit. Okay, if production is greater than sales, inventory has increased, absorption only will give a higher profit. So the absorption costing profit, it will be $10,000 more than the marginal costing profit. Okay, so let's see. The absorption costing profit will be 10,000 less. That's not the answer. The absorption costing profit would be 10,000 greater. Yes, that's the answer, B. Okay. So make sure that you have a good grip of this. So the key is to remember what this slide says. It has everything that you need to calculate marginal costing profit from absorption or absorption costing profit from the marginal costing profit. Okay, so I'll give you a minute, take it down, because this is, in the study text and stuff, it tends to be like a small area, but this is one area where they like to, ask you questions in terms of MCQs. Okay, so take it down. These three things, I can explain the logic behind this, why when production increases, inventory increases, and why absorption gives the higher profit. But knowing the logic at this point, okay, so if you had come for a lecture, I will definitely explain the logic, but that is never examined. They never examine why absorption gives higher profit when inventory increases. Okay, so if you're finding it difficult to understand the logic, which obviously you might have gone through during your lectures, just remember these rules. If inventory increases, absorption gives higher profit. If inventory reduces, marginal gives a higher profit. If you remember that, that is more than enough to tackle any question in the MA syllabus. Okay. Right. So, yeah. I give you a minute. You can go through this. I mean, you can take a picture if you want. And then I'll show you the workings as well if you want to take it down. Right. So this is that. This is the working. We just wanted the difference. So we got that by calculating the change in inventory into the fixed overhead per unit. And then we try to figure out what happened to inventory. Production was greater than sales, so inventory has increased. Absorption should give the higher profit. Okay. Now, the next question, let me show you that also, is about accounting for materials. Okay, and I find this area, this particular chapter, students tend to find it a little challenging. Okay, so I want to spend some time and go through, I'll take about 10 minutes just to summarize this chapter for you. Okay, so after my summary, you shouldn't have a problem with any question to do with accounting for materials. Okay, so let me go to my slides first. And let me quickly go through what accounting for materials is about. Okay. So this goes as chapter 3 in the Kaplan study text. Right. So let's go through it in detail. Okay. So first, let's understand why we give so much of weightage for materials. Okay. Why are we asking so many questions? Why are we, it's at the very beginning of the syllabus, why are we giving so much of importance for accounting for materials? Okay. The reason is this. If you think of traditional manufacturing, okay, so I'm not talking about, a business where most of their, let's say like an online tutoring company. I'm not talking about something like that. Okay. I'm talking about traditional manufacturing where there's nothing is online. Everything is happening in person. So let's say, for example, we are manufacturing something like pens. Okay. So if you take our business, okay, the manufacturing of pens, we have to take the plastic from somewhere, we have to make the ink from somewhere, and then we have to put it together, make the pen, sell it. Simple as that. Okay. But what you have to understand is, for a company that is into traditional manufacturing, the cost of materials. So materials means the cost of plastic, the cost of ink, the cost of metal, okay, whatever they are using to make their product, it is a major component of their total cost. Think about it. If you are manufacturing pens, then obviously one of your major costs is the cost of buying the material. Okay. So if we are not going to deal with that cost properly, then what will happen? If you're just taking rough figures for materials without having a proper breakdown, then chances are that you might do a mistake here and there, and that will directly affect your profits. Okay. Whenever something is of a big portion, okay, so if something is a big portion of your business, definitely you have to spend some time and analyze that and make sure nothing goes wrong in that area. Okay, because even if you make a small slip here and there, that in terms of numbers, it will, be a big issue for your, your statements and your profits. So that's why we have to focus on materials a lot. Okay. So the first area that we look at is, why do we have to control our inventory? Okay, so why are we, talking so much about controlling inventory? The reason is very simple. Okay, if you don't have a proper control over your inventory, then there are so many disadvantages that can happen. One thing is, the most important thing is, there can come a point where you have business, you have customers coming and asking for your product, but unfortunately, you're not able to produce the product in the factory because you don't have raw material. So let's say, for example, you have a customer asking for 1 million pens. You have everything. The factory is there, the people is there, everything is there, but we don't have the plastic. So everybody will have to just stand and wait until you get the plastic from your suppliers. So to avoid that situation, that's the main situation you have to avoid. You have to make sure that you have a check on how much inventory you have. Okay. Then somebody can come and say, okay, that is the problem now. So go buy about 1 million kilos of plastic and keep it in the in your store. So you will never run out. Okay, keep a lot of inventory. But then that's another problem, because if you have a lot of inventory, then maybe one warehouse won't be enough. You might have to rent another warehouse just to keep the inventory. So you can't just, pile inventory to the extent where you're not going to use it, because then you will just incur unnecessary holding costs. So what is this holding cost? Things like rent. You might have insured your inventory. So the insurance cost that you will have to incur. Okay. So the cost also shouldn't be too much, but at the same time, we should not run out of inventory at the same time. Okay. And finally, if it's something like plastic, it's fine. But let's say we are doing something like yogurt manufacturing. Okay, we are buying milk from somewhere and keeping it in the stores, and then we are fermenting and making yogurt. So if you buy 1 million liters of milk, within 3 days, it's all going to get spoiled. Okay, so we don't want to be in a situation where we buy inventory, keep it in the stores, but we haven't used it, it got spoiled. So to avoid all of these situations, we have to control our inventory, which is what this particular chapter is all about. Okay. So the first part that we talk about is the different documents that you have to raise when you are, when you need inventory in the factory or in the production department. Okay. So I'll go through this really quickly. I don't want to waste time with it. So in a factory or in a company, basically, you will have the production department, the stores, the purchasing department, You'll have your supplier and you'll have the accounts. Okay, so there are certain documents that have to go to and from these different areas of the business if you want inventory in the factory. Okay, so let's say the production department, they have a new order. So they want, say, 500 kilos of plastic. Now, if they don't have the 500 kilos of plastic, what they will do is they will raise a document called a material requisition. And they send that to the stores. And what will this material requisition say? It will say, we need 500 kilos of plastic by this day because we have this order to fulfill. Okay. Now, if the stores has that 500 kilos of plastic, no problem at all. They will just send the goods to production. Okay. But now we're talking about a situation where they don't have that 500 kilos that the production is asking. Then what will happen? The stores will raise a document called the purchase requisition. So there they will tell the purchasing department, we need 500 kilos of plastic of this quality, please purchase it. Then what does the purchasing department do? They decide on a supplier. So sometimes the supplier might be already available. We might be having a supplier. If not, we will issue tenders. Tenders means we will, basically it will be like an advertisement where you will say, this company is looking to buy plastic of this quality. All of you who are interested in dealing with us, send us a quotation. We will choose which one is most suitable for us. So after you choose the supplier, you will send him a purchase order, okay, a PO. You send him a PO saying, we want to purchase 500 kilos of plastic. A copy of the PO, you will send it to the stores department as well. So why do you send it to the stores? To tell them you sent a purchase requisition, right? We have honored that. We have placed the order. Okay, so just to keep them informed about that, and also expect delivery soon because we have sent the PO to the supplier. And another copy, they send it to the accounts department. Why do they do that? Because at the end of the day, accounts only should settle any cash balances with the supplier. So beforehand itself, the account should know that maybe now in 3 months' time, we will have to pay this supplier for the 500 kilos of plastic. So they have to be kept informed. Then what happens? The supplier sends the 500 kilos with a delivery note to the stores. And the stores, they will check it. They will check if the 500 kilos is there, if there are any damages, have they sent less than what we ordered, did they send more? Okay, so whatever they have actually received, they will send back a goods received note to the supplier. So what does the goods received note say? It will say, okay, now say for example, the supplier is saying, I sent 500 kilos. But in the stores, when we count and check, it was only 490 kilos. Okay, it was only 490 kilos in the stores. So then the goods received note will very clearly say that we did not receive 500, only 490 was received. Okay, so the goods received note will be sent to the supplier. A copy will be sent to the accounts department as well. Why are we sending to the accounts? Because see, the PO said 500 kilos. But what we have actually received is 490 kilos. So what we pay should only be for 490. Okay, so to make sure that we pay the correct amount only, we send a copy of the goods received note to the accounts department as well. Once that's done, if supply is fine, he says, yeah, it was a mistake. We only sent 490. He will send you an invoice for the 490 kilos. If everything is matching, if the invoice is matching with the goods received note and the PO, then the accounts will release the payment to the supplier. And meanwhile, while all of that is happening, from the stores, they send the goods to production and they can start whatever work they have with that 500 kilos of plastic. Okay, so these are the different documents that, will move from one department to another when it comes to traditional manufacturing. Okay, I'm saying this again and again because today a lot of things have changed. Okay, today most of our businesses, we don't really rely on raw material as such. Okay, but that is a discussion for another day. For our syllabus, we are just concerned about the traditional techniques. Okay, right. So that is one area. Then we move on to something else. Called computerized inventory control systems. Okay, so this is a little bit of theory where we just talk about, I'm sorry, the slides, I didn't go through this and erase it. But anyways, it doesn't matter. It's basically where we talk about things like extranet. So what is an extranet? We give access to, information about things like our inventory to maybe our customer or our supplier. So even before we realize that, we are running short of inventory, our supplier will realize it and, send the goods to us. Or our customer will realize we don't have any product and so they want, come to us and, ask for it and things like that. Okay, so that is the extranet. Then we have things called the transaction processing system. So in simple words, this is where you will have many transactions happening over the day. Okay. So at the end of the day, if you have a TPS, it will give you a summary of the different transactions that you did. So we can probably have sales as this much. Okay. And we sold a breakdown we can have, right? A breakdown meaning product A, we sold for this much. Product B, we sold this many units. C, we sold this many units. So end of the day, we can see which products are going or more fast moving than other products. So that is a TPS. And MIS is where, again, it is like a TPS. It gives you a summary, but not just based on our internal information, but external information as well. So for example, it will consider the particular sales or a demand of a particular product in the market. Okay. And see, okay, fine. If we even internally we have sold say 500 units of product A, the market also saw a demand for product A. Okay, so MIS simply combines internal plus external information. Okay, that part is not too important. Let's go to the more important area, which is this. Okay, when it comes to costing your inventory, okay, when it comes to costing your inventory, there are three important costs that you have to consider. First is the purchase cost. So what is purchase cost? This is basically the amount that you have to pay your supplier. How much you pay your supplier, the selling price of that unit. Okay. So how do we calculate this? It's the purchase price multiplied by the annual demand. We call it P into D. That's the first cost that you will incur. The next cost is called the ordering cost. Put simply, this is the transport cost. Most of the time, we're talking about the transport cost. So if we place an order, our supplier will say, okay, per unit, it is $20, but delivery is $100. So that $100 delivery, we call that the ordering cost. Okay, and in addition to that, let's say we have somebody in our office calling the supplier and telling him, can you please send this much of units? Then that person's salary, they're doing an administrative work now, so that salary will also fall under ordering cost. But in questions, it will most of the time just be the transport. There is a way to calculate that as well. It's the cost per order into the demand over the quantity that you ordered. Okay, the cost of ordering. So for example, maybe the cost of ordering can be just the delivery cost. Okay, maybe $100 delivery into the annual demand divided by the quantity that you ordered. The third type of cost that you will have to incur is called the holding cost. So that is the cost that you have to incur if you keep inventory in a warehouse. So what is that cost? Things like rent, insurance. If you have insured your inventory, then for every inventory piece, you will have to pay the insurance company a premium. So that amount. Let's say we didn't have money to buy the inventory. We took a bank loan. So then the bank loan, we have to pay interest. That also falls under holding cost. So how do we calculate holding cost? It's the cost of holding into the quantity ordered divided by 2. Cost of holding, usually they will give it to you directly. If not, it will be a percentage of the purchase price of that product. Okay, so these three equations are very important. Okay, so why students find this difficult is because all three usually they explain all of this in about 4 to 5 pages. So by the time you come to holding cost, you have forgotten about the purchase cost. Okay, so what is important is for you to calculate each of them and add the three together if you want to calculate the cost of inventory. Okay, so take this down if you haven't, because this is a very key area of your syllabus. If you have this, about 60% of the questions will be based on just this. Okay, so it's basically like a summary of how to calculate the inventory. And this is what you need for the question as well. I'll give you 5 minutes. Even if it takes 5 minutes, it's fine. But this area is very important, right? If you don't know these equations, that's definitely going to be a problem. Right. So I hope you've taken this down. Thank you. Right. So we know how to calculate cost of inventory. Okay. So the next area that we have to know about is there is a particular quantity. Okay. There is a particular quantity because you can see, for example, we can either order 1,000 units a month or 2,000 units a month or 3,000 a month. It doesn't matter. Okay. It's up to us. So let's just see this graph. I'll show you something here. Okay. So let's say, for example, we need 12,000 kilos of some, let's say, plastic every year. Okay, so that is our material. We need 12,000 kilos. Now, as a business, we can take a decision, right? We can order maybe 1,000 kilos a month. And if we do that, then the supplier, he will come to our factory and deliver 12 times a year because 1,000 kilos a month means every month they will come and deliver 1,000. Ultimately, for 12,000 kilos, they would have come 12 times. So let's say the transport cost is $100 per order, 12 orders, so 12 into 100, our transport cost alone will be $1,200. Okay. Now, if we feel, okay, this transport is a little too high, let's not order 1,000 kilos, let's order 2,000 a month. So then they don't have to come 12 times. It will become half. They have to only come 6 times. Okay, so 6 orders a year, that will be 6 into 100, 600. Okay, so what you have to understand is as the order quantity increases, the cost of ordering or the transport cost, it keeps on dropping. Okay, so that is what this line is going downwards. Okay, why is that happening? Because as the order quantity increases, the number of times they have to come and deliver will reduce, and so the transport cost will keep on reducing. Okay. But as the order quantity increases, what will happen? We might need another warehouse because now we are going to get more products at the same time. So maybe the the warehouse is not enough. So you have to rent another warehouse. Rent cost might increase. Holding cost might increase. So rent might increase. Insurance might increase. So when the quantity increases, the holding cost, it will look like this. It will keep on increasing. Ordering cost will reduce, but holding cost, it will increase. So what happens is when you have two lines like this, right? Mathematically in a graph, when you have two lines, you can combine them together. Okay. And it will form a curve like this. Okay. So what does the curve say? When you add the holding cost and ordering cost, until a particular quantity, the total cost, the addition of the two, it will reduce. Okay, why is it reducing? Because the transport cost is reducing. Okay, and the increase in the rent and insurance is not as much as the reduction in the transport cost. So that is why total cost is reducing. But after one point of after this quantity, the total cost will also start to increase. Why? Because yeah, transport cost is reducing, but the holding cost is increasing more than that. So for example, maybe now at this point, if you go more than that quantity, you might have to rent another warehouse. So that's why the holding cost is increasing. So what is our goal? We have to make sure that the quantity that we order is this minimum quantity where the total cost is the minimum figure. And that quantity is called the EOQ or the economic order quantity. So how do I know what is this quantity? There is an equation that I can use to calculate the EOQ. Okay, so that is important. So basically, there were three costs that we spoke about. The purchase price, I told you to take it down. The purchase cost, the ordering cost, and the holding cost. So the EOQ is where the addition of all three will be the minimum. Okay, so if you order at any other quantity other than the EOQ, it will definitely be more than how much you calculated if the quantity was the EOQ. Okay, so how do we calculate this EOQ? This is the formula. Okay, so if you have the EOQ formula, that's all you need. The question will give you all the information to put into the formula. Okay, right. Then we also talk about another area called the EBQ. It's similar to the EOQ. There's nothing much different about it. It's just that EBQ has to be used in a situation in only one scenario. Instead of using EOQ, you have to use EBQ. What is that scenario? Let's say you have a shop. Okay, you have a retail shop. And let's say we are selling oil in that shop. Okay, so all types of oil, let's say coconut oil, olive oil, castor oil, all the oil is sold in that shop. And the oil that you're selling, the supplier for it is a factory and we own the factory as well. So you can see it's a very rare situation where the shop and the factory is owned by the same party. So then let's assume the shop COQ, it was 5,000 units. Shop COQ is 5,000 units. Now say in the factory, they were producing olive oil. At one point, they're producing olive oil. And what does the shop do? They place an order for 5,000 units of coconut oil. Then what will happen now? Because both are the same party, the factory will say, look, I'm doing olive oil now. Now, if I have to produce coconut oil, I have to wash all the machines and all that. It will take time. For now, I have 3,000 units. You take it, you keep it. Give me 2-3 days time. I will finish off the olive oil production. Then I will do the coconut oil. I'll start coconut oil and I'll send the remaining 2,000 units. You can't do this if it's a third party, right? If it's a third party, if he orders 5,000, you should give 5,000. But now since this is the same party, this kind of a thing can happen. Where first they will send 3,000, then after some time they will send the remaining 2,000. But then what happens when you do this is in the shop, at any given point, they will never have 5,000 units of coconut oil. Reason is, now the factory has given 3,000 units and then they will start selling that. Okay, so customers will buy. So even after the 2,000 units comes into the shop, let's say the customer bought 100 units. Okay, just saying, before the additional 2,000 came, let's say they sold 100. So 3,000 minus 100, now there are 2,900 units. After this, when we get the additional 2,000 and we add what we already have, can you see the maximum number of units that the shop will have is only 4,900. Okay, so for this reason, because usually when EOQ means that amount should be there in your inventory, but that is not happening here. So to avoid a stock out situation because of this, when we are placing an order, we have to use the EBQ formula and not the EOQ. Okay, then the quantity that we order, it will cater to the fact that we are not getting that entire EOQ amount into the shop. Okay, so it's a very similar formula. It's just that we have to add 1 minus D over R. So D is the demand divided by R is the production rate. Okay, so we will see questions where we will use EBQ, but just know that this is scenario why EBQ came into place in the first day. Why it came into place in the EOQ. Sometimes in certain situations, we won't have that EOQ quantity in our shop. Right. Then we have to look at something called monitoring inventory levels. Okay, so just a few words that you have to know. Let me show that also. I don't want to leave anything untouched. So let's say, for example, we know that our EOQ is 42,500, the quantity that we will order. Okay. So at a given time in a month, as we, near the end of the month, okay, the inventory units, it keeps on reducing. Then when it comes to 36,000, when we reach 36,000, we might place a new order because obviously it will take time for the supplier to deliver. And then we will continue selling. And then at one point we will get the goods, and again our inventory level goes back up to 42,500. Same thing happens in the second month as well. Once we reach 36,000, we place an order, take some time, and then we get the new shipment. Okay, so every month this will happen. The time between you placing an order and receiving the goods, it's called the lead time. Okay, it's called the lead time. The amount that you order, the quantity that you order, that's called the maximum stock level. This 36,000, the point where you place the order, it's called the reorder level. And the 16,500, basically beyond this, your inventory never falls. Okay, so that is called the minimum stock level. And 0 to 16,500, that is called your buffer stock. So that is like a stock that we keep in case of some unforeseen event. So for some reason, let's say now in this country, we had a petrol shortage. Okay. So in a situation like that, maybe we place the order, but the supplier is delivering after 2 weeks. So then we might have to use our buffer stock before we get any new goods. Okay. So these terms you have to just know, and each of them has a separate formula. And unfortunately, these formulas are not given in the exam. So you have to go through them and you have to memorize them. So reorder level, this is the formula. Minimum inventory has a separate formula, and maximum has another one, and average inventory also has another formula. Okay, so I'll show you a slide where everything is summarized. So you can take it down if you want. Then finally, we look at inventory valuation method. So this is very simply FIFO, LIFO, AVCO. You must be familiar with it. The different ways in which you can value inventory. Okay, so that is also covered in this chapter. Then we talk a little bit about just in time. Okay, so that is a newer method where we don't keep any inventory at all. We will start production only after the customer has placed the order. Okay, so you just have to know a little bit about JIT. The double entry is to do with materials. And that's about it. Okay. Now, finally, I'm going to make life easy for you. This is a summary of accounting for materials. This is all you have to know when it comes to accounting for materials. Okay. Only one thing I did not mention is when it comes to EBQ, I told you the formula changes a little. But this cost of holding formula, that also changes because normally it's this. If it's EOQ, usually it's this. But if it's EBQ, then the holding cost, it will change a bit. Okay, I didn't mention it because I thought it will overload you. I wanted to mention it when we do the question. But since it's there in the summary, you can just take it down. Okay, the cost of ordering, that remains the same equation. But when it comes to EBQ, we don't call it cost of ordering anymore. The CO, we call it the setup cost. Just two small changes, which I will touch once more in the TRG itself. But anyway, for the time being, you can take this down. This is the summary for accounting for materials. This is one slide. This is the other slide with all the equations that you have to know. Okay, so we have reorder level, minimum stock, maximum stock, and average stock. Right. So take this down, and then we can do that question. Okay, so take all of this down. EBQ and this EOQ with discounts also, just take it down. I will talk about it again in another question because I don't want to overload you with everything in just 10 minutes. I will talk about the EOQ with discounts and how to do the EBQ properly with another question. Okay, so I hope you took this one down. Go to the next slide as well. These are basically all the equations that you need to learn when it comes to accounting for materials. None of them are given at your exam. Okay, so everything has to be learned. So you can see there is a situation for reorder level. There are two equations, right? So based on the question, okay, based on whatever information you have in the question, you have to decide which equation to use. Okay, because sometimes they will give you usage and lead time. So then obviously you can't use the second one. You can only use the first one. Sometimes they will give you minimum stock balance, average usage, average lead time. In that case, you can use the second equation. So based on the question only, you can decide which one to go for. Okay. Okay, so let's read that question and see what it's saying. Okay, so it's saying a company uses the economic order quantity model to establish reorder quantities. The following information relates to the forthcoming period. So they're saying order costs are 25 per order. Holding cost is 10% of purchase price. So can you remember I told you usually holding cost, it comes as a percentage of purchase price. So they've given you the percentage purchase price and the answer as well. Annual demand is 20,000 units. The purchase price is $40 per unit. The EOQ is 500 units. No safety inventory are held. What are the total annual costs of inventory? That is the total purchase cost plus the total order cost plus the total holding cost. The total cost of inventory, I told you, is three different costs together. They're asking you, give me the answer for all of them added together. Okay. So I'll use the slide itself. It'll be easier. So I asked you to take it down. Let's go back there. Okay, so these are the three equations that we have to focus on. Okay, I hope this is enough. Should be okay. Okay, so if you need to get the purchase cost, we have to take the purchase price and multiply it with the annual demand. So what was the purchase price? 40 per unit. So that is 40 into the demand was 20,000. Okay, when you're doing these questions, careful, because in the equation, demand is always annual demand for 1 year. Sometimes in the question, they can give you a monthly demand, a weekly demand. So all of them, you have to convert it to annual demand and then only use it in the equation. So 40 into 20,000, that will give you 800,000. Then, so that is the purchase cost. Then let's do the ordering cost. That is the cost of ordering, which they say is 25 per order, multiplied by again the annual demand, which is 20,000, divided by Q is the quantity that we have ordered. So here they are saying the company uses the EOQ model now. So EOQ only will be the quantity that they order because that will only minimize their cost. That will be 500. So 25 into 20,000 divided by 500, the order cost will be 1,000. Then let's do the holding cost. The cost of holding, they're saying, is 10% of purchase price. The answer is directly given to you as $4. So we can take it 4 into the quantity that we order is the EOQ divided by, okay, so that will be again 1,000. Okay, now guys, this ordering cost and holding cost, it being equal to each other is not a coincidence, okay? At the EOQ, ordering cost will always be equal to holding cost. Think about it. In that graph that I showed you, I'll show you that graph. Where is that? Yeah. Can you see? At the EOQ, the holding cost line and the ordering cost line, they are meeting. Okay, so that is why at the EOQ, the holding cost and ordering cost is equal to each other. Okay, so that is not just a coincidence. That will always be the case at the EOQ quantity. Okay, right. So now if you want the total inventory, it's a very simple thing after this. Add the three together. Okay, so 800 plus 1,000 plus 800,000 plus 1,000 plus 1,000. So that will obviously be 802,000. So the answer will be C. Okay. You can see if you have your equations in place, it's simple. Okay. Only if you are having, the equations in different places, you will get confused what figure to put where. Okay. Right. So it's 7:10. Since we started at 6, I'll give you guys a 15 minutes break. You can pray whatever you want and be back at 7:20, right? 1 second, 15, 7:25. Okay, so be back at 7:25. We will continue. We'll be speaking a bit about forecasting techniques, relevant costs, and things like that. Okay, so be back if you want help in those areas. So I'll see you at 7:25. Okay, I hope you guys are back. Let's look at this question. Okay. So it's saying here, if sigma x is 100. So sigma x is, if you don't know what that means, if you have a set of x values. Okay. So let's say we have x values 1, 2, 3, 4, 5. Okay. So if you add up all of them, then we call it sigma x, meaning the total of x. So that will be 5 plus 4, 9, 10, 11, 12, 13, 14, 15. It's 15. Okay. So they're saying sigma x is equal to 15, sigma y is 400, sigma x squared is 20,040, sigma y squared is 32,278, sigma xy is 8,104, and n is 5. Which of the following values for a and b are correct in the formula y equals a plus bx? Okay. So when you see this, it should strike you that they are talking about a technique called linear regression. Okay, linear regression. So to explain what this technique actually does, okay, let's just assume that y equals a plus bx. Y is the total cost, okay, and x, let's say, is the out. Okay, so let's say, for example, we are manufacturing discs. Okay, if we want to know, okay, if we want to know what is the total cost that we will incur for, say, 100 discs, okay, then if we have the values for A and B, let's say A was 5 and B was 2, okay, then all we have to do is take y equals 5 plus 2 into, instead of x, you can put 100. So that will be 200 plus 5, 205. So basically, if you have this y equals a plus bx equation, and if you have the values for a and the value for b, you can find the total cost for any level of activity, any output, 100 units, 2000 units, 2 million units, whatever it is. You just have to put the value instead of x. You have a and b. If you add it up, you will be able to get the total cost. Okay. Now the question is, how are we going to find this a and b? Because only if we have A and B, we can get total cost for any number of units. So why will we need that? Let's say, for example, till date, we have only produced, say, 5,000 units a month. Okay, so up to 5,000 units, we know what is the total cost we will incur. Now, suddenly we get a new customer. He is asking us to produce 10,000 additional units. So before giving him a price, if we have the equation, it's easy for us to decide what will be the total cost for 10,000 units. We don't have to actually produce 10,000 and then decide what is the cost. We can just put 10,000 instead of x over here and get the total cost. Okay. So linear regression, it gives you two equations for you to use to find A and B. Okay, so those two equations, thankfully, it's given to you in your exam. So I'll show you that. This one. Okay, so y equals a plus bx. A is this and b is this. Okay, so you don't have to think too much. You can just put in whatever figures they give to you into the equations to get the value of a and b. Now, what you have to understand is, to get A, you need B. Okay, so first you have to do B. Once you get the answer for B only, you can do A. Okay, so let me quickly do that. So B equals n times sigma xy minus sigma x, sigma y over n times sigma x squared minus sigma x, the whole thing squared. So this is the equation. So let's go to the question and put in the information that they have given us. They're saying n is 5. So 5 times sigma xy. Let's see if that's given to us. Yes, 8,104. Minus sigma x, sigma y. So sigma x is how much? 100. Sigma y is how much? 400. This whole thing you have to divide it by again n times sigma x squared. So n is again 5. Sigma x squared is also given directly to 20,040. Minus sigma x and the whole thing squared. Okay, so there's another figure called sigma x squared. They're not asking that. They're telling you to take sigma x and square that. They're two different things. Okay, be careful. So sigma x was 100. The whole thing, you have to square it. So if you do this, you will be able to get the answer for B. Okay, so let me put this in the calculator and tell you how much you should get. You can also try. Okay, so B should equal to 2.6. I'll give you a second. Check if you can get that answer when you put it in your cal. Because if you can't, then that's a problem. We have to solve that problem first. Okay. Okay. So in case you couldn't get it in your cal, I'll show you how to do it. Okay. So this is the cal, right? You have to put in everything as it is on your equation. So first start with the fraction. Open brackets. Be careful, right? Wherever there are brackets, put the brackets because if not, it will definitely do it wrong. 5 into 8,104. Close brackets. Minus 100 into 400. Close brackets. Come down. Open again. 5 into 2040. Close brackets. Minus 100 square. That also 100. Put it in brackets. Close the bracket and put the square on top of that. Exactly how it's in the equation. You put it in your calculator and press the equal sign. 2.6. Okay, so if you don't have a calculator where you can put the fraction like this, and it's basically there's a gray calculator, right? I think it's 100 ms. If you're using Casio, FX 100 ms or 991 ms, then how you have to do this is you have to get the answer for 5 into 8,104 separately. Then 100 into 400 separately. 5 into 2040 separately. 100 squared separately. Okay. Then these two answers subtract it, get the answer. These two answers subtract it, get the answer, and then divide the two together. You have to do it step by step. If not, there is a very good chance that it will go wrong, right? Because the calculator follows the rule BODMAS. If you have heard grade 5, grade 6, they say BODMAS all the time. So it follows that BODMAS rule. So if you don't put the brackets properly, then it is most likely going to go wrong. Okay. So that's how you should put it in your cal. So we have B. It should be 2.6, a positive figure. So that will be either this answer, which is the second one, or the fourth one. So let's find A also quickly. A, the equation is this. A equals sigma y divided by n minus B times sigma x divided by n. Correct, Hamdan. Okay. So sigma y, let's go to the question. They said it was 400. N, they said it is 5 minus B is 2.6 times sigma x is how much? 100 divided by n. So that is going to be again 5. 1 second. Okay. So again, let me put this in the cal. 400 divided by 5. If you guys don't have the natural display, that is the cal which can do this, put the fractions like this. It's a good idea to invest in one. Okay. Because you're doing MA, you have a lot of papers coming. Having this will definitely make your life easier. Okay. So 28. A is 28. So answer will be this B. A positive 28 is A and positive 2.6 is B. So that is linear regression. Okay, that's basically how you do linear regression to get the answer for A and B. Right. So you can see wherever in MA, wherever they are talking about something other than accounting. So in this case, this is statistics. Okay, this is not really accounting. They will, more often than not, they will give you the equation directly itself. Now you can see, now things like calculating the purchase price, the purchase cost, the cost of ordering, those equations are not given, only EOQ is given. That's because those equations are to do with accounting. So very rarely only they will give you that. But look at these ones, coefficient of variation, variance, standard deviation. Those are all equations to do with statistics. So that's why they give it to you. They don't expect you to know that. Okay? Right. Let's look at the 18th one. GS company is considering accepting a 1-year contract which will require 4 skilled employees. Okay, so they're thinking of a new contract and you will need 4 skilled employees if you accept this contract. The 4 skilled employees could be recruited on a 1-year contract at a cost of 40,000 per employee. The employees would be supervised by an existing manager who earns $60,000 per year. Okay, it is expected that supervision of the contract would take 10% of the manager's time. Okay, so if we are going for this new contract, we have to hire 4 new employees. Okay, and our supervisor who is already there with us, he will supervise those employees and it will take 10% of his time. That's what they're saying. That is one option. Second option, they're saying, instead of recruiting the 8 new employees, the company could retrain some existing employees who currently earn 30,000 per year. Okay, so they already earn 30,000. We can retrain them a little bit. Okay, the training would cost 15,000 in total. If these employees were used, they would need to be replaced at a total cost of 100,000. So what they're saying is this. Either you get 4 new employees, pay them 40,000. Or you already have employees now. Retrain 4 of them. Okay, retrain 4 of them and that will cost you 15,000. But obviously, if they are going to do this new job, you have to replace them, right? Because they would have been doing something already now. So there is nobody to do that. You can get somebody from outside to do that and that will cost you 100,000. Question is asking you, what is the relevant labor cost of the contract? Okay, so it's talking about something called relevant costs. So what is a relevant cost? Okay, it's very simple. 3 words you have to remember. Okay, if a cost has to be relevant to the decisions that we're taking, it has to be a future incremental cash flow. 3 words you just have to remember. Okay, so if a cost has to be relevant, it has to be a cost that you're going to incur in the future. So it can't be something that you incurred in the past. So it can't be a sunk cost. So examples are research and development cost, something that happened, in the past. You can't include that as a relevant cost. First thing. Next thing is it has to be incremental. That means you have to incur this cost only if you take up the new contract. So for example, look at this supervisor. He is earning 60,000 per year. Okay. And even if you take this new contract, yeah, he will supervise. It will take 10% of his time, but still he's earning the same 60,000. So there is no increase in his payment. Okay. So the 60,000 is not incremental. Whether you take the contract or not, 60,000 has to be paid. So that can't be a relevant cash flow. So incremental means only after you take up the contract, you will have to incur that cost. Thirdly, it has to be a cash flow. Simply, it can't be something like depreciation, which is just an accounting adjustment. Okay, it has to be a real cash flow. So it's asking what is the relevant labor cost of this contract. So this contract there were two options. Okay, we can either go for option A or option B. So let's first find out what is the total cost of the two options. So we had option 1, which is to get new employees. So let's write that option 1. What was that? We get 4 skilled employees at 40,000 per employee. So employee, let's just call it a salary, 40,000 into 4. Okay, so 40,000 into 4 you will have to pay. So that will be 160,000. That will be the cost. It's relevant. Why? Because it's a future cost. You have to incur it incremental. Today, you're not paying anybody this 40,000 into 4. Only if you accept the contract, you will have to incur this cost. It's obviously a cash flow. Okay. Then, that is the first option that you have. You have to incur 160,000. So now this supervisor's salary 60,000, you can't include it here. Although the supervisor will actually spend some time, it is not incremental. So it can't be considered a relevant cost. So this is option 1. Then let's look at option 2. Option 2. So what is that? Instead of recruiting, you can retrain some existing employees who currently earn 30,000. Training will cost 15,000. Now the currently earning 30,000 is not incremental. It's already existing. But the training, that is incremental. It's a future cost. You will have to incur it incremental cash flow. So the 15,000 will be relevant. Okay, the 15,000 is relevant. If these employees were used, we will have to replace them at a total cost of 100,000. Is that relevant? It's future. In the future, you will have to incur this 100,000 incremental. Only if you retrain these employees, you will incur this 100,000 cost. So that is definitely an incremental cost. It's not something that is already existing and it is a cash flow. So definitely you have to include that as a relevant cost. So let's say replacement 100,000. Right. So now let's just take totals. If we go for option 1, it will be 160,000 relevant cost. If we go for option 2, it will be 115,000 relevant cost. If you see, both the answers are there. Which one do you think you have to choose? If you are a rational person, then obviously you will choose the option that is cheaper. You're not going to go for the option that is more expensive. Okay. So like Adil is saying, yes, you have to go for 115,000. Okay. Right. So that will be the answer, which is A. Okay. Now this is another forecasting area. So it's saying for a set of 6 data pairs, so X values and Y values, you have 6 of them. For the variable X is profit, Y is sales, the following values have been found. So they have sigma X, sigma Y, sigma X squared, sigma Y squared, sigma Y squared, XY. Okay, everything is given. What is the correlation coefficient? Okay. So correlation coefficient, it's a value, we call it R. Okay. And why do we calculate this? We calculate it to see how strong the relationship is between X and Y. Okay, so we use it to calculate the strength of the relationship between X and Y. You don't have to worry too much. Like I said, this is a statistics area. So even this equation, it is given to you in your exam. But what is important is you have to know that correlation coefficient means they're talking about R. The letter that we allocate for correlation coefficient is R. So the equation is given like this. R equals this. So if you don't know that correlation coefficient was R, then even though the equation is given, you will not be able to do the question. Okay, so the equation is there. Let's use it and calculate the correlation coefficient. R equals the big equation. Okay. N times sigma xy minus sigma x sigma y, and then the square root of, divided by the square root of n times sigma x squared minus sigma x, the whole thing is squared, Okay, then we are closing this bracket. Then we are opening the second bracket. N times sigma y squared minus sigma y, the whole thing, we're squaring it. Okay, so that's the equation. Okay, so let's put in the figures. Directly it will be given in the question. You don't have to worry. So let's see. R equals N. So they're saying for a set of 6 data pairs. So 6 means N is 6. Okay, N is always the number of data pairs that you have. So they're saying for a set of 6, so N will be 6 times sigma xy, which is 14. Sigma xy, which is 14, minus sigma x, sigma y. So sigma x is 2 and sigma y is 15. That part is easy. Should be divided by the square root of n times, again 6 times sigma x squared. So that figure is already given 30. Okay, sigma x squared minus sigma x, the whole thing should be squared. So sigma x is how much? 2. 2 squared. Okay. Then you open the next bracket. Again, n times, which is 6 times sigma x squared. Sorry, sigma y squared, which is 130. Minus sigma y, the whole thing squared. So sigma y was 15 squared. Try it in your cal. See if you can get the answer. When it comes to these chapters, the challenge is not putting the figures in the equation. Anybody can do that. The challenge is to put the equations in the cal and get the correct answer. Okay. So let me also try. You also try if you can get the answer. And then I will show you how to do it. So if you don't have a calculator where you can put the figures like how it is, then you don't have a choice. You have to do 6 into 14 separate, 2 into 15 separately, all of the brackets separately, take the square root and then do the division. Okay, don't try to put everything in the gray calculator and expect the answer to come. It won't come. Okay, because it's too complicated to put it separately. Let's see if somebody's got the answer. Correct. 0.17 is correct. Okay. So let me quickly show you how this works as well. Open the fraction. 6 into 14. Okay, 6 into 14 minus 2 into 15. Come down. Then we need the square root. So I'll put the square root sign. Open brackets. 6 into 30 minus 2 squared. Close the bracket. You multiply that with, open brackets again, 6 into 130 minus 15 squared, close the bracket and the equal sign. Okay, so the answer is 0.17. So if you have, like I said, the natural display, it's very easy. And not just for MA, guys, even for papers like FM and even a little bit of PM, having this cal makes life a lot easier than if you're using the gray one. Okay, so if you are thinking of changing, or if your gray one is old, it's slow and things like that, a good option will be to go for the natural display. Okay, take my advice, wherever a cal can do something, okay, wherever a calculator can do something, always use the cal. Okay, because now if you come for my lectures, even how to do now, sometimes the sigma x, sigma y, all of them, it won't be there in the question, it won't be given, right? You have to draw big tables to get it, but you don't really have to do that. Even if you have the raw data, you can get the sigma x, sigma y, sigma x squared, even the direct answer for r using the cal itself. Okay, so you don't ever try to waste time with something that the cal can do. Okay, so these things like regression, correlation, coefficient, things like simultaneous equations, all of those things are functions that are readily available in your calculator. Okay, so wherever possible, use it. Especially, I'm telling you, normal distribution, another example, where you can use the calculator to get all those answers. Okay, but I can't show it to you right now, because the questions where you have to use the cal usually has to give you the values of x and y separately. So sometimes they give it to you, right? X is 1, 3, 5, 7, it goes on. Then y values, corresponding y values, they will give you 60, 75, and so on. And then you have to calculate each of them separately. If you look back at your notes, you will see you might have done this, where you will have big tables getting x, sigma y, sigma x squared, and so on. So if you find that those tables are difficult, just go on YouTube. I will show you. I can show you if there's a question, but in your exam they don't ask like that. Okay, so that's why I'm not taking the time to show you. But in case you want to know, when you have these figures like this also, you can get correlation coefficients, regression equations and all easily just using the calculator. So if you are interested, you can learn it. Okay. I always show it in my lectures, right? It's just that for a TRG, it's unnecessary, right? I'm trying to show what is most important. That is not important, because in a question, they usually don't give just the data sets. They will give it to you like this. Okay. Right. Let's move on to the next one. It's saying Z company wants to calculate the total cost of a job. The estimated cost for the job is as follows. We have direct material, direct labor. So 10 kilos at $10 a kilo. And direct labor is 20 hours at $5 per hour. Variable production overheads are recovered at the rate of $2 per labor hour. Fixed production overheads for the company are budgeted to be 100,000 each year and are recovered on the basis of labor hours. There are 10,000 budgeted labor hours each year. Other costs in relation to selling, distribution, and admin are recovered at a rate of 50 per job. What is the total production cost of the job? It's a straightforward question. Example of job costing. Okay, where you have a specific job, using the information that you have to decide what is the production cost. Okay, so I know we haven't discussed job costing so far, but this is just common sense. You can try it out and see. I'll give you 5 minutes. See if you can get what is the total production cost of the job. You're saying 440, Hamdan. You have missed one small part. Partially correct. Just one small area you have missed. Okay. So let me do this. We want the total production cost, right? So we have direct materials. Let's do it one by one. Okay. Direct materials. How much is that? 10 kilos at 10 per kilo. So 10 kilos into $10 per kilo, which will be 100. Okay. Then we have direct labor, which is 20 hours of labor. Each hour we pay 5. So 20 into 5 is also 100. Variable production overheads. Variable production overheads. So what is that? 2 per labor hour. So we had 20 labor hours. Okay, from here. So 2 into 20. That is 40. Fixed production overheads are budgeted to be 100,000 each year and are recovered on the basis of labor hours. There are 10,000 budgeted labor hours each year. Okay, so first we have to calculate something called the OAR, or the overhead absorption rate. So let's do that. OAR equals the budgeted overheads, which is 100,000, divided by the budgeted labor hours, which they're saying is 10,000. Okay. So the overhead absorption rate is 10 per labor hour. Okay. So the overheads are absorbed at a rate of 10 per labor hour. So now let's absorb it onto the cost. Fixed overheads, 10 per labor hour. How many labor hours did we actually use? 20 hours. 10 into 20. So that will be 200. And then let's just take this total 200, 440. That's what somebody mentioned. Okay. But other costs in relation to selling, distribution, and administration are recovered at a rate of 50 per job. They're asking the total production cost of a job. So when it comes to job costing, we include selling, distribution, overhead as well. Okay. So the 50 also you will have to add here and you will get 490. Okay. This is the total cost. Right. So the question is saying, what is the total production cost? Okay. I hope I did not confuse you. Okay. When it comes to the total production cost, this is correct. Production cost. And then this is the selling, distribution, and admin. Okay. So that is a 50. When it comes to job costing, okay, when it comes to job costing, we will add the 50 and say the total cost is 490. Okay, but now, just now I checked the question, it's saying total production cost of this job, which, like I think somebody said, it is 440. Okay, but why I added the 50 is just to show that when it comes to job costing, we include the selling, distribution, admin as well. When it is absorption costing or marginal costing, we don't do that. Okay, just to show you the difference between the two. But since the question is directly saying total production cost, then yes, of course, it's going to be 440, which is C. Okay. See again, even the wrong answer 490 is part of the 4. Okay, that is the biggest disadvantage with MCQs. You will do a calculation, you will see, yeah, okay, my answer is there. And you will, even choose it and be happy about it. But what you have to understand is the answers that they put, they are just not random answers. They are the answers that you will get for common errors as well. Okay, so be careful when doing MCQs. Okay, right, so 440. Right. Let's start mixed bank 2. Let me just check if I have shared these questions with you. Have I shared it on the Telegram group? I haven't shared it, right? You guys could have asked me. I'll share it right now. Because, just give me a second. Okay, so mixed bank questions. Once I'm done with the entire mixed bank, I will share the answers as well, okay? So this is what we have been doing so far. If you had asked me, I would have shared it. It's just that it slipped my mind. Okay, so this should come. Right. So let's look at this question and see what they're talking about, okay? So it says here, a division of a service company is aware of it's aware that its recent poor performance has been attributable to a low standard of efficiency amongst the workforce compared to rival firms. Okay, so a service company, maybe they, let's say they're just delivering lectures. Okay, so they have realized that we are not doing so well compared to our competitors. And the reason is they're saying because the workforce is not efficient. Okay, then they're saying the company is adopting a balanced scorecard approach to setting performance targets. They're adapting a balanced scorecard approach to setting performance targets as part of its objective of closing the skills gap between itself and the rival companies. The division's management has set a target of providing at least 40 hours of training each year for all its employees. What does this performance target reflect? So I'll explain what they're saying in simple English. They compare their workforce to their competitors and they realize that the workforce is not efficient. Okay, so what did they do? They thought, okay, let's make them efficient. So let's train them. Okay, what is the training? 40 hours of training every year for all their employees. Now they're asking you, this training, which performance target will it reflect? Okay. So I'll give you some time to think about that. And let me quickly explain the balance scorecard to you. Okay. So what is this balance scorecard? Okay. Now, traditionally, back in the day, companies, they only focused on financial figures. They were only concerned about the profit. They were concerned about the cost, the selling price, those kind of things. They were never concerned about things that were outside of numbers. Okay. But with time, people realize that if we want to really do well as a business, we can't just focus on the financial aspect. It's important, right? Don't get me right here. You have to be concerned about financials. We can't just forget about it. That is the most important thing for a business. But in addition to that, we have to focus on other non-financial factors as well. So what are these non-financial factors? Things like our quality, things like our customer satisfaction. Okay, those are areas that we have to focus on because These non-financial areas, if you ignore, then in the long run, it will affect the financials. In the long run, it will affect the financials. Why? Because let's say we are not focusing on quality. Okay, so maybe 1 year, 2 years, we will survive in the market. But after that, what will happen? People will say, for that particular brand, quality is not good. Let's go for another one. Customers are not satisfied means one time you might have sales, but when he is going to come for a second time, he will definitely not choose you. So ultimately, your sales will drop. Okay. So balance scorecard is a particular technique where we say focus on 4 areas. Focus on 4 areas. If you focus on these 4 areas and if you do well in all of them, then definitely your business will thrive. Obviously, the first area that we're talking about will be financials. Okay, be careful. Make sure your ROCE is on point. Okay, make sure that now if your profit is, lesser than your competitor, then that is definitely a problem. See why that is and solve it. First one, look at the financials. Next, we say, look at the customer. Okay, so see what your customer thinks about you. Okay, take a brand like Apple, for example. In my opinion, I feel they run based on brand loyalty more than anything else. Okay, people, once they start using the product, they just get attracted to it and they are just, they just don't want to change. That's it. Yeah, there's there's nothing special about an iPhone. Think about it. Yeah, it's user friendly, it's reliable, all that is there, but there are many other phones that give the same thing. Okay, but still people are not willing to move from iPhones to another product because of brand loyalty. So ultimately, what are we talking about? Customer perspective. Okay, so the balance scorecard says consider what your customer thinks of you. So if your customer has a negative impression of you, then please, do something and change it. Because if not, in the long run, definitely the financials will take a hit. Okay. Next one, they say, look at the internal business processes. So what they're saying is, in your business, you will have different processes. No, so if you're manufacturing, for example, there will be a line where you will make. Now, if you're making tables, you will cut the wood, you will assemble, you will polish, all of that, right? So make sure that you do that at maximum efficiency. Do that at maximum efficiency. So I'll tell you a good example for this, right? Take pizza delivery. Okay, take pizza delivery. One aspect that they can talk about in their processes is how long it takes to deliver a pizza. Okay, now especially when you talk about pizza, people will definitely choose the option where the pizza is going to come fast. Taste is also important. Okay, now if you give a crappy pizza in 5 minutes, anyway, people won't buy. But I'm saying, even if the taste is mediocre, but the delivery you promise you will give within say 15 minutes, then what will happen? If you are, you're having friends, you're not going to go, even if a pizza is even more tasty, but they take 2 hours to deliver, you won't go for that option. You will go for the mediocre pizza that will come in 15 minutes. Okay, so you can see, if you can do something about your business processes and make sure that it is efficient, that will also contribute to the success of your business. So balance scorecard says look into that as well. Finally, they say look into innovation and learning. See how we can do something new for our customer. How do we develop our customer? How do we develop our product? Okay, don't forget about it, because there are some businesses, okay, where people are happy with the product. Okay, they're happy with it, but nothing new is getting added to that product. Okay, so let's say, for example, we were making TVs, televisions. We had an excellent screen, excellent sound system, everything is fine. But now we are reluctant to do smart TVs. Okay, because back in the day, there were no smart TVs, right? There were just TVs. You have to get a connection and use the TV. That's it. But if we were a TV manufacturer, refusing to learn how to incorporate a software into your TV and make it a smart TV, then definitely with time, you will get outdated. No matter how good your screen is, no matter how good even if you build the TV in metal, even if you give the best sound system, today, if it's not a smart TV, will somebody buy? No. Okay. So that is why the balance scorecard is saying innovation and learning is also important. Okay. Don't just forget about it. So how do we achieve this innovation and learning? One main way that you can achieve innovation and learning is uh, through training. Okay, by training, you can always incorporate innovation and learning, because if you include something new into your product, then those who are working on the product, first of all, you should teach them about this new thing. So how do we do this teaching? Through training. Okay, so now let's go back to our question and see if we can figure out which target they're talking about. Okay, so what is it? It's training. So I already told you it has to be innovation and learning, but we'll just look at the others as well. Customer means you're doing something for the customer, right? So maybe you'll a social media campaign or something like that. It might change your customer perspective. Training, it won't necessarily change customer perspective. Innovation and learning, it does. Internal business process perspective, usually we don't attribute training to that. Okay, it can. Okay, now another point I have to mention is it's not very easy to decide a particular thing that you do, which one it will fall under, because sometimes it can be a little bit of innovation and learning and a little bit of internal business as well. Okay, but when it comes to teaching your employees something new, because now they're saying they're closing a skills gap, that is more closer to innovation and learning than internal business process. Now, if you were teaching them something like, how to work more efficiently, how to work faster, something like that, then maybe we can choose C. So one of the disadvantages of this balanced scorecard is it's difficult to determine which of the four it will fall under. Especially these two, you will have a particular thing that you're doing that can fall under either. It is a disadvantage. If in a question, in this paper, you won't get it, but papers like PM, you can just mention that as a disadvantage itself. Okay, so in this case, it will be B, innovation and learning. So just not to complicate things for you, whenever you see training, don't think too much. It will always be innovation and learning. Okay, but remember, in real life, it can fall under anything. Okay, it can fall under innovation and learning. It can even fall under internal business. But for the purpose of MA, usually training is for innovation. Okay, definitely it's not finance perspective, right? If you're trying to do something for the finance, then you have to think about cost cutting and things like that. Okay, right. Which of the following could be included in a time series based sales forecast? What do you think? I know we are going to all the areas of the syllabus, but that's the whole point of the TRG, where we try and cover every area. Okay, so now time series is again forecasting, comes with regression, correlation coefficient, time series. Don't worry, I will explain time series in a bit, but I'll just give you some time to see if you can figure out what you can include in a time series based forecast. Okay, I'm not getting an answer. We'll see. Okay, let's quickly talk about time series as well. Okay. So when we were talking about linear regression, I think I have an answer. All. Okay, I'll address that, Hamdan. Give me a minute. When we were talking about linear regression, I told you if you want to forecast the total cost. Okay, so I'll go to that also. See, if you have this y equals a plus bx, just forget the numbers, right? I'm just trying to show you this. You can forecast something like production cost. For any number of units, what is the production cost? You can easily forecast. Okay. So usually linear regression, we used to forecast costs only. Production cost only, we usually used to forecast it. But you can use it for other purposes as well. So for example, if we kept y as sales, okay, y as sales and excess time, y as sales and excess time, and we have different figures, then we can even forecast sales for a different period. Okay, so to explain what I'm trying to say here, To forecast anything, you can use linear regression. Okay, so whatever you want, one second. This is the equation, right? Y equals a plus bx. Now, a and b you have to calculate. Y can be anything. It can be total cost. Most of the time, that's what we get. It can even be sales. Okay, whatever you want, you can forecast using this linear regression. You just have to put the necessary information. So, if you are getting total cost, you can put activity as x. If you want sales, maybe you can put something related to time as x. Okay, so whatever figure you want, you can use the linear regression. Get that straight. But usually, when we are trying to forecast sales, a better technique is to use something called the time series analysis. When if you're trying to forecast cost, a better technique would be to use linear regression. But if you're trying to forecast sales and X is time, anything to do with time, then a better model would be the time series model and not the linear regression model. Okay, so let's quickly look at what the time series model is. Okay, so it is a series of figures or values recorded over time. Okay, and a time series, obviously, like in the question itself, it's saying there were 4 components: the trend, the seasonal variation, cyclical variations, and random variations. Okay, so what are they? Trend is the long-term movement over time. So if you take sales, for example, now any business, if you're doing well, from year to year, there has to at least be a slight increase in the sales, right? At least a slight increase. So definitely, the slight increase, it will fall under trend. What is seasonal variation? That is, now for example, if you're selling national flags, then definitely you will see a spike in your sales in the month of February. Okay, so that is the seasonal variation component. So what I'm trying to say is, when you're trying to predict your sales, you have to consider the trend, you have to consider the seasonal variation also. What is cyclical variation? That is basically where in the, how the country is doing basically. Okay, so if the country is in a recession, for example, like where we are right now, then anyway, all businesses will see a drop in their sales. So we have to include that also in our forecast. So what are we trying to do in time series analysis? Put simply, we are trying to forecast sales. That's what we're trying to do. Okay, so what are the things that we have to consider? The trend, the long-term movement. We have to consider the seasonal variation. We have to consider the cyclical variation as well as random. Okay, random means something that we can't really predict. For example, an earthquake, a tsunami, COVID, things that we can't predict, that will also obviously affect our sales. But now, as a financial manager, let's say you're a financial manager in a company, or a management accountant, you can predict the trend, take it into consideration. You can predict seasonal variation, take it into consideration. Cyclical also you can. Can you predict random variation? Can you predict if, there's going to be an earthquake? You can't, right? If you're doing that, you have to be some astrologer or something. Okay, we can't predict a natural disaster. Okay, so although random variation also will affect our sales, it is also a component. It can't really be included in the component, in the calculation of a time series, because we are not in a position to predict it. Okay, so what can we actually include? That is what the question is asking. We can include the 3: trend, seasonal variation, cyclical. You can include in the forecast, but the random fluctuation, we can't. Okay, because we can't predict the future. The answer will be C. So whoever said all, it's correct. The components, things that can affect sales, are all 4. But what we can forecast is only the first 3. Okay. Right. Which of the following could be, which of the following is the best definition of the return on capital employed, ROCE? Okay. So the equation for ROCE is this. ROCE equals the profit before interest and tax divided by the capital employed. Okay. So capital employed means it is your equity plus your debt. Okay. So let's see if that answer is there. Profit before interest and tax. Okay. Divided by capital employed. So ordinary shareholders funds plus non-current liabilities into 100. Capital employed is that. So that seems to be the answer. You can see you get easy questions also. Okay. Not everything will be difficult. Okay, so just to say that capital employed is the equity plus the debt. So debt is non-current liabilities. So the answer will be PBIT divided by ordinary shareholders funds plus non-current liabilities. Obviously, we get a percentage, so multiplied by 100. Right. Okay, this is another area. Let's read it. Good quality saves money, but the cost of quality can be analyzed into cost of conformance and cost of non-conformance. Which of the following costs are classed as quality-related appraisal cost? If you don't know the area, now for example, if you don't know what they're talking about, what do you do? The only thing you can do is just guess. Okay? Because this is a very niche area where they usually don't test, but if you're unlucky, you will get a question. So if you don't know about it, don't leave it blank. Just guess something. Just click something. Okay? But I'll talk about this in a bit. If you know, try and see what the answer will be. If you know it, then you're in a good position, right? If you know this, then obviously you know the main areas. You can quickly sit for your exam. Okay, don't waste time. If you know this particular question, then that's a sign that you're in a good position to sit for the exam quickly. Don't delay the exam, guys, because the longer you take, once you come to the point where you know about 90% of the syllabus, quickly sit for it, because the longer you take, the more you're going to forget. Okay. So once you find yourself in a position where you are comfortable, you know about 90%, most of the questions you can answer, then please go ahead and sit for it. Because the longer you take, then even important areas that you were good at, you will end up forgetting. Okay. So what it's talking about, that question, is something called quality related cost. So what is quality related cost? It's the cost of making sure that your product is of good quality. Okay, so if you have to make sure that your product is of good quality, then there are certain things that you can do. For example, you can have like a quality controller. So if you have a quality controller, obviously you have to pay him a salary. That is a cost. So that is why it's called a quality related cost. Because if you are not concerned about the quality of your product, you won't have a QC. Why will you have? You'll just make the product, sell it and call it a day. But because you're concerned about quality only, you're hiring him and paying him an amount. So that is why it's called a quality related cost. So now these quality costs, you can classify it into 4 different categories. Okay, one is called the prevention cost. So prevention means basically the cost that you incur to make sure that nothing goes wrong. Okay, so make sure that the quality of your product doesn't drop. So before the quality has dropped, you're taking some precaution. So example is routine repairs or training cost. You're training your employee before anything. So when he makes the product, he won't make a product of low quality. Routine repair, you're making sure that the machines are working well, you're oiling it, all of those things. So making sure that even before production starts, the chances of the quality dropping is less. That is the prevention cost. Okay. Then we have something called a appraisal cost. So what is this? It's basically inspecting your materials. So inspecting and you're testing the quality of the products that you're using or whatever you're using to make the product. You're testing it even before you start production. Okay. So example is inspection of raw material. So even before you start making a table, you look at the wood and see, okay, the wood doesn't seem to be good quality. It seems to be wet. So we can't use this. Before we do production, let's change the wood. Okay. So the cost that you have to incur to check if, the wood is of good quality, that is called a appraisal cost. Now, prevention and appraisal costs, they are called conformance costs. So, why is that the case? Because they are costs that you incur even before the product is produced. Okay, so even before you make the product, you incur it and you prevent making a product of low quality. Then we have the non-conformance cost, which is internal failure and external failure cost. So, what is internal failure? That means now you have made the product is of low quality. So, that's why we are saying it's a failure. Okay. But one good thing has happened. You have discovered it before we sold it. So we have figured out that our product is of low quality in the factory itself. So our customer is not seeing this blunder. Okay. So it's bad that we made a product of low quality, but it's good that we figured it out before our customer. So at least our brand name doesn't go. Okay. That is the third type of cost. Finally, external failure cost. This is where we have figured out that the product is of bad quality, but unfortunately, we figured it out only after we gave it to the customer. Okay, so let me give you an example of an external failure cost. Maybe after selling it to customers, you just ask for a feedback and the customer is telling you very bad. Now, the cost that you have to incur to ask the feedback, that is the external failure cost. The fact that it's happening after you transfer the good to the customer, that makes it fall under this category. Okay, so those are the 4 costs relating to quality. So let's look at what the question asked us. Which of the following is classed as a quality related appraisal cost? So they're talking about the second type. Okay. Reinspection, administration of customer complaint section, performance testing, and training in quality control. Which one do you think will fall under appraisal? Okay, I have an answer, reinspection. Reinspection is an example of internal failure. Okay, because after the product is made, something is telling me, no, let's check this again. Let's check the product even after it is made. Because when it comes to appraisal, we are talking about even before the product is made. Reinspection means after the product is made. So that is an example of internal failure. Okay. This administration of customer complaints, that is straightforward. That is external failure because now the customer has also come into the picture. Okay. Then if you look at performance testing, okay. Performance testing, it is basically maybe checking how your, the machines are working, or more to do with, how is, let me explain this like this. Let's forget the performance. Let's go at training in quality control. Okay. So if you look at training in quality control, that is an example of prevention. Okay. It's an example of prevention. Why? Because we are training our employee, telling them, don't make this mistake. Okay. But now if you look at performance measurement, performance testing, this is after we have done the training. Okay, we have done the training, we have finished it, and then now we are checking how is our employee working. Is he doing well? Is he not doing well? Now that point, this performance testing, it happens either while making the product or little before that. This can fall under appraisal. Okay, so performance testing is the one that will fall under appraisal. Reinspection, like I said, that is internal failure. This is external failure. Performance falls under appraisal and not this one, prevention, because we check performance after training. So that is why it falls under appraisal cost. Right. So these things, right? These quality costs, balance scorecard, it's one major disadvantage is it's very difficult to figure out. Now, especially here, it's very difficult to put it between prevention and appraisal. It's not easy. Okay, so that is a disadvantage. You don't have to worry about it at MA because it's like, we know prevention means usually training. Appraisal means performance relating cost. But in real life, it's difficult to put between the two. Same thing with balance scorecard also. Okay, so Like you can see, it's hard for me to explain it itself. So think about it. In real life, it is obviously going to be difficult to determine where to put that particular cost. Okay. Right. Which two of the following costs would be considered to be the responsibility of the manager of a profit center? Okay. I give you a minute. This is easy. You should be knowing it. Okay, so let's quickly go through that as well. Uh, so if it comes to responsibility centers, what is a responsibility center? I'll explain this really quickly because I know most of you will know this. It is a situation where we are giving control to other departments. Okay, what that means is, now if you're a small shop, then most probably the owner will control everything. He will control the staff. Now, let's say it's a small restaurant, for example. He might control the person who is cooking. He will control the waiter. He will control the cleaning. Everything is controlled by the owner. Okay. But once the business starts growing in size, one person can't obviously handle everything. So that is when we start transferring responsibility to other people. Okay. So there are 4 types of transfers that can happen. One is, we can give somebody the responsibility of only focusing on the costs of that particular department. So let's say, for example, we give him a particular department and we tell him, you have to make sure that the cost that we incur in this department is $50,000 and that's it. Your job is to just keep a check on the cost. Okay. Then there's another type called a profit center. Profit center means the person who is responsible for the profit center, we tell him, you are only responsible for the profit that you are getting in that particular center. Okay. So obviously you will look at 2 things. You will look at the cost and you will look at the revenue. Okay. The revenue minus cost will only give you profit. Then there is another type of center called a revenue center. So here we tell him, the person who is responsible, you are only responsible for revenues. So cost is only cost, revenue is only cost, profit is the combination of these 2. Then we have the third one called the investment center. And here we tell him, you are responsible 100% of everything. So you are responsible for the revenue, the cost, the profit, and you even have liberty to use this profit, invest it somewhere. Okay, if you want, you can use that, invest it in something that you need, and even make sure that this entire center functions properly. Okay, so that is an investment center. So if you look at 20.5, if you're a profit center, then you have to have control over cost as well as revenue. Okay, so let's see what it can be. Direct labor is a cost. Okay, direct labor is a cost. So definitely if you're a profit center, you will have to be responsible for this. Direct labor, that is one answer. Variable production overhead, that is also a cost. Okay, direct material, direct labor, variable production, fixed overheads, all are costs. So that also you have to be responsible. Imputed interest on capital invested. So any investment that a profit center manager, he doesn't have to be responsible. That is the responsibility of investment center managers. And depreciation also, this manager didn't have the liberty to use the profit and invest it anywhere. He can't buy machines if he wants or anything. Those kind of things, he has to get approval. So definitely any depreciation is also not his responsibility. Okay. So what is the responsibility of a profit center? The cost and the revenue. In this case, there is no example of a revenue. So the 2 cost will be the only 2 areas that he has to be responsible. Okay. Right. 20.6. Now, this is an area that a lot of people have problems with. It's called variance analysis. Okay. So, it's saying here, in a period, 12,250 units were made, and there was a favorable labor efficiency variance of 11,250. Okay. If 41,000 labor hours were worked and the standard wage rate was 6 per hour, how many standard hours were allowed per unit? Okay. Now, variance analysis is an area where I tend to share something with students. Okay, so let me show you what that is. It is, before I show you that, let me quickly go to that chapter and just show you what you need to know in this syllabus. Okay. Now, when it comes to variance analysis, these are the different variances that you have to know to calculate. Okay, I'm so sorry. It's a little messy. It's just that when I'm doing lectures, I just need to tick off when I finish it, right? Just to keep the students a little entertained. Okay, doesn't matter. So when it comes to variances, there are two types of variances, right? There are cost variances and there are sales variances. Okay. When it comes to cost, I told you cost means in a cost card, we have direct materials, direct labor, variable overheads, fixed overheads. Okay. So those four areas, there are certain variances that you have to know to calculate. And under sales also, there is a price variance and a volume margin variance. Okay. Now, obviously, I don't have the liberty to, go through everything in detail. Okay, because that will take a lot of time. Now, variances, to be honest with you, it will take at least 4 to 6 hours to properly explain everything. Okay, but what I can help you out with is giving you a summary of whatever you need to know in terms of equations. Okay, so that is the maximum I can do because obviously there is a time constraint. So let me go here and show you the summary. Just give me a second. Okay. Now, if you remember, I told you there are different variances. For cost, there were certain variances. For sales, there were certain variances. Okay. So the cost variances, the first one is the direct material. If you remember, it was a direct material and there was a price variance and a usage variance. What you need to know is, if you have to calculate price variance or usage variance, you need these three, we call it's the boat method, okay, because we're drawing something like a boat over here, right? So you need these equations, these three equations, you need them to calculate the price variance or the usage variance. Okay, and then this is another situation where you have closing stock. This is a very rare situation. Just focus on this for now. Okay. Then if you want the labor variances, then you need these three equations. Only then you'll be able to calculate rate and efficiency. Okay. If you need variable overheads, again, these equations you need. If you need fixed overheads, you need these equations. Same for absorption costing, marginal costing when it comes to sales variances. So as we do questions, I will use these equations and show you how you can use an equation to get the variance that you need. Okay. I'll do the question right now and then I'll give you time to take all of this down. So let's directly go to the question and see how these equations will help us. Okay. So let's see what it says here. They are talking about a labor efficiency variance. Okay. So they're saying 12,250 units were made and there was a favorable labor efficiency variance of 11,250. So this efficiency variance, they have already calculated it for us. Okay, then they're saying if 41,000 labor hours were worked and a standard wage rate was 6 per hour, how many standard hours were allowed per unit? So now they're talking about this area, right? This efficiency area. So let me just quickly copy that equation. Okay, I'll just quickly copy it and put in whatever information that's given to me in the question itself. So if we want the efficiency variance, we just need the second part. I'll just copy what we have here. Actual at standard and standard. Okay. So we have actual hours into standard rate. Standard hours for actual production into standard rate. And this will only give you the efficiency variance. Okay. So we have the information. Let's see what is given in the question. So they are telling me that the labor efficiency variance was 11,250. It was favorable. Okay, it was 11,250 favorable. Then they're saying in a period where 12,250 units were made, there was a favorable labor efficiency if 41,000 labor hours were worked. So we have actual hours here, right? They are telling us that the actual hours worked is 41,000. And they are also saying the standard wage rate was 6 per hour. So standard rate also they are giving us, it was 6. Okay. Then here again, it's asking for standard rate. So we can put 6. Let's take a total here. 41,000 into 6. So that will be 246,000. Okay. Standard hours for actual production means basically now we produced 12,250 now. That was the actual production. The question is asking you how many standard hours are allowed per unit. Okay. So what you have to understand is you can get this figure, standard hours for actual production, based on everything else that we have. Because now standard hours for actual production into 6, it should give some answer. Okay. That answer, it has to be 11,250 more than 246. Because think about it. Just look at this. We are saying that the efficiency variance is favorable. Favorable means, what that means is, the actual amount that I incurred for labor, because see, this box is only actual, this is all standard. Okay. The actual amount that I incurred for labor is 246,000. If my efficiency is a favorable variance, then this is actually lower than what I predicted, what my standard was. So this figure has to be higher by 11,250. So 246 plus 11,250, which is 257,250. That should be the standard. Okay, so what I'm trying to say is, I expected to pay 257,250 to my laborers. That was my budget. Okay, but actually I paid less. I paid 246. So that is 11,250 less, and because I paid less, that is favorable for me. Okay, so what's the point here is the standard hours for actual production. If that was X into 6 should give me 257,250. So the standard hours for actual production X will be 257,250 divided by 6, which is, let me check, 42,875. Okay. 42,875, that is the standard hours for actual production. So the standard hours into actual production, which was 12,250, should only equal to 42,875. So if I want the standard hours, that will be 42,875. 1 second, I've added a 0. Divided by 12,250, which will be 3.5 per hour. Oh, sorry, 3.5 hours per unit. So it will be 3.5. Do you understand that? Because depending on where you are with regard to how you understand variance analysis, that will only decide whether you understood that or not. If you didn't understand, tell me. I will take a day just for variance analysis. If you understood this, then we can continue the TRG as we do now. Okay, but if you didn't understand this, that means we have to take a separate day, maybe next week, where we will cover variance analysis from scratch. If you think you need that, let me know now. But if you have understood what I did, okay, because if you have to understand what I did right now, you have to have a basic knowledge of variances. But I can see now one person has been very frank and told he didn't understand. If the others, there are 5 of you, if you guys also can't get it, tell me, I'll take another day. Just like how I would teach it at a lecture, I will teach you variance analysis from scratch. Okay, so I'll give you 2 minutes to decide whether you want that or not. Because if you can't understand this, then no matter how I try to explain it, you won't get it. I have to start from the beginning. Only then you will understand. And variance is a chapter where they can ask 2 to 3 MCQs. They can even focus the MTQs on variance. So it's an area where you can get a good 10 to 15 marks. Let's take a day for variances, right? If you want the day for variances, next week, I want you to do this. Okay, I will share a question. Yeah. I will share a question right now on the Telegram group. Let me share it right now. If not, I will forget. Take a printout of it and keep it with you so that you will have it in hand. Okay, if not, you will have a problem going back and forth. You won't understand what's happening. So to avoid that, only I'm telling you, get a printout of it. It will be easier for you. This is the question. Okay. Once I'm done with it, I will share the summary as well with you. Right now, it's a Word document. I will convert it to a PDF because if not, the positions will change. Okay. So I have shared this question with you. Take a printout. We'll take the entire class even next week just to do variances. I want to focus on it because it is important. And there are a lot of questions in this mixed bank itself which will focus on variances. So if you don't understand the basics of variances, it will just be a waste of time. Okay. So let's continue for the next 10 minutes. We'll do more questions, but I will focus on variances first next week. Okay. The reason why I didn't do it beforehand is usually the TRG, it's done after a batch of MA that I have taught. Okay. But the last batch I taught was, it ended in December. So I really don't know who is joining the TRG for this session because we didn't really run MA sessions. We were focusing on the other knowledge level. Okay. So if it was a session that I had taught, then I can be confident. I know that my students know what I'm talking about. Okay. Because I didn't have this problem in the TRG that I did in November because everybody who joined it was somebody who came for my lecture. So it was easy for me to just carry on from there and, because I know that they know what I'm talking about. But since here I don't know who my target is, it's always better for me to start from scratch because I can't do it for every chapter. Obviously, variances I'll do it because like I said, it takes about 10, 15 marks of your paper. Okay, so take a printout of that question. All the variances that can be questioned, I will do it based on that one question. Okay, so after that, you should be comfortable with variances. If you have anybody, friends, anyone who has problems with variances, tell them to join the TRG next week. I will do it from scratch. Okay. It is a little difficult to do a TRG for a batch that I didn't teach, right? Because I'm not able to gauge what you know, what you don't know. So if what I'm saying is not making sense to you, please let me know. Okay, it will be easier for me to, adjust a bit. Right. Because in November, when I did the same questions, but most of the people who were on the call I knew, like personally I knew, because they had come for the lecture. So it was easier for me to, just build up on that. But here it's like I'm not sure if this is at a level much higher or if I should go lower. I'm not really sure. Okay. But anyway, that's what I'm trying to explain everything from the beginning right now. For example, when I did materials today, I basically explained that entire chapter summarized to you. Okay, so as much as I can, I will do that. But variances again is a chapter that I can't do quickly, because if I do it quickly, you will get more confused. Okay, so that's why I just want to take a day for that. Okay. Okay, 20.7 is a repetition of a question that we did, the very first question we did today. Try it out, see if you can get the answer. Okay, because we spoke about this marginal costing, absorption costing, how to get the profit from absorption costing if you have the marginal costing profit and vice versa. So read it and see if you can get an answer. In its first year of operations, a company produced 100,000 units of a product and sold 80,000 units at 9 per unit. It earned a marginal costing profit of 200,000. It calculates that its fixed production overhead per unit is 5. They're giving you marginal costing profit 200,000. They're asking you what profit would it have earned under an absorption costing system? That's a question. I'll wait for all of you, the 4 of you who are here, and see if you can give me the answer. Because this you should be able to, because this is something that I spoke about exactly at the beginning of the class today. Anybody with an answer? Okay, let me work on it. In its first year of operations, the company produced 100,000 units of a product and sold 80,000 at 9 per unit. Okay. And then they're saying that the marginal costing profit was 200,000. So marginal costing profit was 200,000. They're asking you for the absorption costing profit. That's the question. Now, we can't directly calculate this. We can first calculate the difference between the two. Okay. So, what is the difference? That is the change in inventory. Okay, the change in inventory multiplied by the fixed overhead absorption rate per unit. So if you look at this, it says we produced 100,000 and we sold 80,000. So the difference is 100,000 minus 80,000, which is 20,000. That is only the change in inventory. That's 20,000 multiplied by the fixed overhead absorption rate, that is also given directly, which is 5. Okay. So 20,000 into 5, that is obviously 100,000. Now the question is, we know the difference between absorption and marginal costing should be 100,000. But the question is this 300,000? Okay, because even 300,000 is 100,000 more. Okay, the question is this 300,000? Even then the difference is 100,000, or is it 100,000? Is it less? Is it 100,000 more than marginal, or is it 100,000 less than marginal? Okay, so to decide on that, you have to check the production and the sales. If you look, the production is 100,000 and the sales is 80,000. So the production is greater than sales. So if you remember, if production is greater than sales, then the inventory is increasing. And in that situation, absorption costing gives the higher profit. So 100,000 means absorption is giving the lower profit. So that can't be the answer. The answer has to be 300,000. Absorption gives the higher profit because inventory has increased, and so absorption gives higher profit. Okay. So the difference between this question and the first question is, in the first one, we just spoke how to calculate the difference. Okay, we calculated the difference and then the answer was saying, okay, absorption will be 20,000 more. But we did not calculate the answer for the absorption costing profit. So in this question, we will be calculating the answer for the absorption costing profit. Okay, so like I said, a very common question. Get used to calculating absorption costing profits from marginal and the other way around as well. All right. That's it for the day. I know there's quite a lot to take in. So just to give you a quick recap of what we did this one. Okay, how to get marginal absorption profit. Then what we did in detail today really was accounting for materials. So if you understood accounting for materials, that's a big takeaway from today. We tried to understand variances, but it's a little confusing. So let's not, burden ourselves too much. You can forget about this question. I will focus on variances next week. Then we spoke about responsibility centers. We spoke about quality costs. We spoke about forecasting. We spoke about the regression analysis and also time series analysis. We spoke about the balance scorecard. Okay. And lastly, we spoke about relevant costs. Okay. So those were the main things that we took away from today. So if you have got that, that is, a good spread of a lot of areas of your syllabus. Okay. Right. So next week we'll do variances. And then we will look a little bit at sampling and then capital investment appraisal. Those are the only areas that we have to look at. Is there any specific area that you guys are having a problem with? If so, you can drop it now in the chat. I will try to cover it. Okay. The advantage that we have this month is that we have 5 TRGs. That's the advantage. We have 5 TRGs. Usually it's only 4. But this month you're getting 5. So that is why I'm able to add in 1 day just to focus on variances. Okay. Right. So that's it for the day. I'll see you next week. Please inform your friends if you want variances. How many sections are there in the MA paper? Okay. We have 3 sections. Okay. One is MCQs. So like this. Every question will be 2 marks. Okay. That will be worth 30. Then we have another section called MTQs where we will have a scenario. Okay. And there will be 5 MCQs just talking about the scenario. Okay. So let me quickly show you a mock paper. I don't know if I can show you the mock. I'll see if the specimen is there. One second. Just give me 1 minute. I show you it because if you don't know that, then you don't know what you're working towards, right? It's fine. I don't think we'll have a problem with this. I'll just show you the mock, okay? So there will be 35 questions, okay, based just on MCQs. Once that is done, you have section B, and this is MTQs. Okay, so basically you will have a scenario and there will be 5 questions just talking about that particular scenario. So there will be 3 questions like that. That is your paper. Okay, so there will be 35 MCQs, 35 small questions, and there will be 3 MTQs. So basically 3 MTQs where you have a scenario and there will be 5 questions under that. That's all for your paper. Everything will be anyway, although we call it an MTQ, that also is like an MCQ. It's just that 5 MCQs will be related to each other or related to the scenario that you're talking about. Right, so that's it for the day. I'll see you all next week. If anybody wants help with variances, please ask them to join. Okay? Right.